Hello and welcome to the Becker Private Equity and Business Podcast. My name is Chanel Bunger, and today I'm excited to speak with regular guest Matt Wolf of RSM, who joins us weekly to share insights into economic trends he's keeping an eye on. Matt, thank you as always for joining me. Why don't you take it away and tell us about what you're seeing out there?
Yeah, thanks, Chanel. One of the big conversations that we've been having a lot with operators, even some sponsors or other advisors, is around certainly the interest rate environment. And, what is the future? What is the Fed going to do? How is that going to affect capital markets in 2025? And these are all important and relevant conversations. But I don't think that the outcome of those conversations or the outcome of rate movements is going to have the effect that we expect it to, right? I still think a lot of people are stuck in this sort of pre-2022 framework of monetary policy dictating a large portion of economic returns, and it's just not going to be the case. And we can see evidence of this in observations that you can read every day in the financial press about how, lowering interest rates will be a boon to private equity deal making or will relieve companies and their balance sheets and blah blah blah. And there certainly will be cases where this is true. But if we look at the yield curve and we look at 2, 5, 10-year treasury yields, especially the 5 and the 10-year that dictate a lot of the cost of capital for particularly middle market businesses, that portion of the yield curve has done nothing but increase since the Fed began lowering rates. Right, so the market observers, investors, so the so-called smart money in the bond market that does set a lot of cost of capital throughout middle market or broad investing, broad corporate finance. They're pricing in or trying to price in other sorts of risks of, potentially operational risk or geopolitical risk, other things that monetary policy just really can't mitigate. And so, while it is important to look at the interest rate environment, important to understand Fed commentary, look at where the dot plot's going, it's not the end all be all that it once was, right? Monetary policy will not save suboptimal operations, will not save suboptimal capital allocation as it once has. And we're beginning to see that in the markets. And this isn't meant to be some sort of doomsaying sort of forecast, right? I think the opposite is true. 2025 will be a robust year for deal making. We'll see likely a growth in IPO listings, a growth in private deal making. There's certainly lots to do, and it will be an interesting and exciting year across capital markets. We just can't. I worry that we're at risk of overemphasizing this narrative that the Fed's going to lower rates and that's going to save deal making. I just don't think that'll be the case. We might see some reductions in the Fed funds rate. We might not, depending on policy decisions that get made later on in the year. But ultimately, what will win the day is a focus on proper capital allocation, proper operational efficiencies and investments, and from the operators, and on the investor side, just the fact that we still have a dearth of companies, of positions, of investments that just need to change hands, need to be recapitalized, need to be exited, and that's going to drive deal making. So again, not some kind of doomsayer prediction. It's going to be a good year, I think, broadly across capital markets, public, private, however you slice it. Just keep seeing this narrative overstating the importance of monetary policy, and while important, it's just not going to be as important going forward as it was in the prior macroeconomic cycle.
Perfect. Well, Matt, I want to thank you as always for sharing your insights and for joining me on the Becker Private Equity and Business Podcast. I'm looking forward to connecting more as we move further into 2025. Thank you.
Thank you, Chanel.